Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, January 11th, 2021. In this video, I'm going to do it in sort of a reverse order here. By that, I mean I'm going to start out with things other than the market and end with the market. Usually cover the equity markets first. And then what happens a lot of times, if I get too nitty gritty into the charts, it kind of burns up the time. And I want to wrap the video up and then I leave other things out. I just want to start out with crude. I've been posting some semi-frequent updates and trade ideas here on crude. So far, we've almost made it to T3 from all the way down here, somewhere off the divergent low. T4, I still maintain these targets, but last time I updated it was somewhere here recently in the pullback. So we've been making these so far. We're making higher lows. And all we need now is start taking out especially this high and then of course this high, and that will really start to bring visibility in the fact that crude is in an uptrend. Again, an uptrend is simply defined as any security making higher highs and higher lows. Now, so we're not there yet, but what I wanted to add, and I'll just get away from it, we're right now testing downtrend line resistance. I've added this downtrend line since the last update I gave you, and so if we pop that, you can see T2, and that level has been there for a while, and was my first target or second target back here. We hit it, pulled back, and we hit it again. We had another reaction, so that helps to validate 74.30 as a significant resistance level. So if we pop the trend line, then a pop above 74.30 will also increase the odds. We're going to go up to T3 and then T4. Okay, here's Nat Gas. The last update I gave you the other day, we hit the targets, including, and I followed up in the comment section. A couple people asked when we hit T7. I said we still had potential T8. In fact, that day when we were coming up to T7, I revised it from the trend line to this level. Notice that was a very good resistance level. We hit it to the button. I mean, that was... and some folks asked about shorting it. I said, I figured we'd reverse from T7 or T8, and we had a perfect reversal off T8, made for one hell of a pullback trade. And look, we had a couple tags here at T5, which is acting as support. So I think it's most likely along. I don't have, and I said it the other day, I don't have super strong convictions. And usually after a big run up like this, we went parabolic at the end, you run into resistance. You want natural gas or any security is going to digest those gains. What I mean by that, kind of tend to chop around in a range. It might be a little whippy for a while. But with that being said, that's support. You could certainly take a shot along there. The trend is near-term bullish, very bullish. We've had a nice run on it. And there's an uptrend line, minor uptrend line, and the primary uptrend line. So any of those, I don't think we're going to go back that far. Certainly possible, but I'll be watch for some consolidation. This may take a little while and then punch this level. Let me show you what it looks like on UNG. You can see it as well. UNG is these ETNs do a decent but not perfect job of tracking the commodities, and because they have extra expenses they're rolling. But you can see here on UNG, and I've had this chart here for quite a while, this line I should say, and it's about 655, and you can see it was very, very good support. To find the bottom of this trading range right here, and that's what we hit the other day. And you can see I had an intraday pierce above it, just like above my final on UNG. My final target, I had that potential T8 on Nat Gas. We hit it to the button. And that's why I always say, even if you trade the ETFs or ETNs, you want to watch the future. So there's your uptrend line right there. If we happen to get a little bit deeper pullback, and ultimately, I mean, that's a big mountain of resistance. It's big resistance. But if we can punch through there, if you get into the trading range, the way it works, here's your trading range. Usually once you re-enter that, the next move is going to be the next stop will be a move up to the top of the range. And ultimately, if we break it out, that'd be bullish. But again, we took profits, as I highly suggested it, because, overbought, heck of a run up. So I just wanted to update it there, and let's move on. Let's get to the markets, and then we won't make this a super long video. And I don't know if I'm going to get anything out to you today. I've got some big projects going on at home. I was out all day yesterday, out and about in town, getting parts, doing things. I've got a lot going on here, and I'll be doing some of that today, quite a bit of it. I'll do my best. If anything big happens, I'll do an end of day wrap if I can't do another one. Any more updates today? QQQ, 60 minute, 15 minute. There's that max bounce target there, 4941. Hit it yesterday, pulled back. Broke the trend line, the bearish rising wedge. We had a little spike up this morning. You're always going to get noise, I call it, on the opening bell, order imbalances and all that. They spiked up a little bit, but we didn't even print 160 minute. We had a slight, ever so slight close right above the 409 level. And then we broke down, and I told you this morning the next sell signal would come on a break above below 407. The actual support level was at 407.48, we'll call it. So, we took that out, and this is how it works. Then you go down to the next level where you get a reaction. And then the way I had those arrows drawn for you this morning is break that level would take us there. We'll probably get a reaction, which we've already had. You can see we've already bounced off it, so that's the reaction. Whether it goes higher or not, probably not. Not much higher. If it does, 407.48, there's your objective reentry. Come down the trend line. Now, the trend line could be hit together, 404.07. Remember, these were just targets on the way up. I haven't modified this chart. I may tweak some of these, but they're the same. We went long down here, and they were the same price targets I gave you to the upside. And the way technical analysis works is resistance once broken becomes support. So we traded them up, and now we trade them down. That's swing trading for you guys. What else do I want to cover for you? Oh, I posted a couple charts in the comment section below today's initial post. Let me give you that. I'll just cover the live charts. Well, here they are. Here, let me go to that post and just give you my comments here. I added, after I got the post out to you this morning, I'm talking about the one with the QQQ. To be clear, I do not believe it is objective to initiate or add shorts over the max bounce target. Rather, at that point, any stop should be considered somewhat above that level, especially if Apple takes out that top of that T2 zone. Told you the other day, I'm probably not going to get there, and we might not even hit. I think we hit T1 yesterday or today in pre-market on Apple, that 60-minute chart bounce trade. But we'd start taking that out. So what I said about stops are relative to one's price target. So, I can't say a hard stop, is this level, that level. Everybody's different. You might have scaled in, you might have taken it, let's just say hypothetically at my preferred bounce target 2 days ago, or my max bounce target yesterday, or there any combination thereof, scaling in. And you may be, as I said in this post here today, you may be targeting just these quick, there's the chart right here, the quick pullback targets. That's on a 15-minute time frame. Or you may be targeting the longer-term swing and trend targets, and those are on the daily and weekly charts. We'll get to those in 1 second. Let me just show you what else I posted down there. So that's kind of my mentality is, look, if we go up much above the recent highs, today's highs now, much above that, we just start popping resistance level, and then you have the new highs are within spitting distance with very little resistance, so we'll probably make new highs, and I don't think we're going to. In fact, here's a question related to that. Question was, given the S&P is so close to all-time highs, one would think the market would hit new highs before a large pullback occurs. Excuse me, a little too much coffee today. All right, so my reply, I think that's 50-50 in my opinion, meaning flip a coin whether you're going to get a new high or not. Based on the current technical posture of the charts, I still believe that any new highs in the S&P 500 will only be a marginal, meaning a relatively slight new high at best, followed by a major trend reversal. Maybe, maybe not, but I've seen plenty of instances with similar technicals where an index, a sector, or a stock made a marginal new and divergent high, followed by a trend change, as well as plenty of instances where the security made an equal high, just almost perfectly or close to perfectly tested those highs, or fell just shy of the previous high before reversing. In other words, this is my read on the charts. It has not changed in months because we're still within those relatively close. The technical posture has certainly not changed. If anything, the case is a little stronger now than it was, certainly stronger now than a few months ago, because we have some divergences and deeper overbought conditions than we had before. So that's that. So I just wanted to say that, look, what's the difference? If you're talking, if you're playing the long game, if you're, of the same mindset I am, that the S&P, that the stock market's drop, looking at a, 30, 40+% drop, then and you're trading it as such, you're positioning, you're scaling in, you're building long-term positions, you're maybe an options trader and you're trying to figure out, on the timing and strike prices for your options. What's the difference of, where's that high? And SPY right here is about 479.55. So we could reverse now, and technically it's a double top, not technically exactly, but close enough. Again, you're talking, guys, keep in mind, remember, this is a almost 480 point security. So every, we're talking here to get up there, a quarter point to get up here. We could go up 2, 3, 4%, something like that. That's just a marginal or slightly new high. You go up 10, 15, 20%, you start taking out divergences and you start changing the technical posture of the chart. So that's that. All right, let me get back to that chart here. So what I posted here, let's go back here. All right, so there's my thoughts, new high or not, 6 to 1, half dozen to the other. Again, 50-50 odds, anything beyond that, if it's, we pop and run 15%, 20% this year above the highs, then I'm just dead wrong. So that's that, and don't get married to your short positions, obviously. I didn't see this one before. Oh, it's just kind of a comment. Someone's short and hopes the Qs keep falling. Here's those charts I got out to you this morning in the comment section. I'll cover this again. This is 60-minute chart of SPY with some targets there. Boom, boom, boom. And we need to break this minor uptrend line. That's the 60-minute chart of SPY. And then here's the futures. And you have a bearish rising wedge right there as well. This is a hourly chart, and I might have referred to it as a 15-minute, but I can see here it's an hourly chart. And you have a beautiful little, here, let me get to the live chart. So what I said there, you need to take out a sell signal, come on a break of 4,800. Technically, you do have a sell signal on the break of the wedge, but this is what I call BOD, or benefit of the doubt. Let me queue up ES for you, and I'll show you. All right, so this is ES. These are the S&P 500 E-mini futures. I'm covering this both if you trade them and even if you don't, even if you're only trading the Nasdaq or whatever it is. You would definitely want to keep an eye on this because a very, very large subset of traders trade and track the S&P 500. So we're slightly below the and this isn't the all-time, that high from back, the all-time high from the beginning of 2022. This is just the more recent high, and we're a little shy of that so far. But again, for all intents and purposes, that, if we do end up reversing and going much lower, that'll be a double top in this near-term time frame. So there's your bearish rising wedge. That's your divergence line, i.e. negative divergence, just like that was a divergent high right there. And you got this. Then we covered shorts. We went long there. We did this. And now we have come full circle. 60-minute chart, divergent high. And then this is the chart I got out to you in that comment section there. There's your uptrend line, sell signal 1 on the break of the bearish rising wedge there, and sell signal 2, break above 4,800. We're right there right now, so will it prove to be a false breakdown? If so, not necessarily a false breakdown. The wedge is really your sell signal there, in my opinion, but maybe we go into back test the wedge from below, or a kickback rally and then reversal. Ideally, you want to stay below 4,800, especially on a solid 60-minute closing basis. So let me be very clear. Sell signal 1, sell signal 2 in play, even though in fact, the fact that we are that close now, this is the time to, if you were, read that and you wanted to take it, it's still objective to short. But then the way this works is, so if you move up here, I would hold off at that point. I wouldn't short, just like with QQQ, where we're at, on that max bounce target. I wouldn't short above it, but if we fall back below it again, then yes. So it's be short under here or initiate short positions. You don't have to immediately cover if you shorted there. But if we start going up and we start taking out highs, we start taking out divergences, yeah, at some point, again, depending on your price targets, that's the thing. The stops are going to be relative to one's price target using a favorable RR, or risk reward ratio, be it 4-to-1, 3-to-1, 2-to-1. Typically, most trades have at least a 2-to-1 RR. 3-to-1 is, a nice sweet spot. But it depends on the trade. And then targets 47, 45, 46, 48, cover just above. These are the actual support levels. 40, we'll call that 4,600. And then if we can really get the party going here, 4481. So first things first, we need the breakdown to stick, not fail, not come up here, not get back above this trend line in the wedge. You do that and it just mucks it all up. It just really negates. So at most, a back test of the wedge. Anything much more than that. Does it kill the whole thing? No. You can take this line up, which I'm doing now. You still have divergence has been building back here for a while. And that's what shows through on the daily chart. But again, that's the ideal scenario. Okay, I don't know if some of this might have just got cut out. If I'm repeating myself now, because one thing I hate about this screen recording software, when you pause it to collect your thoughts and move to the next chart, sometimes the pause button clicks and works when you click it. Sometimes it doesn't. And same thing when you unpause it. And there's no way to know. If I could get in here and hack their software and code it, I'd have a big flashing, have the screen flash when you're paused, green or something like that. But I've talked to this company before and they're just not responsive on taking suggestions to improve their software. So I'm sorry for that long rant. All I was saying is there's a wedge, 4,800. Anything below there, we're right on it right now. Should open the door for a move down here. If we pull back up, I would not short that above. I would wait for another break. If we regain 4,800 with conviction, let me zoom in, then you might want to hold off. You could easily get a back test of the wedge, but anything much more than that, if we go back up here and we rally now and we take out the wedge, more than just a back test, we go to new highs. Like I was saying a minute ago, again, this may all be repetitive. I think the video was paused when I was saying this, but we're still going to have, and we do have, bigger divergence here, and this shows through on the daily chart. Divergence from this point, divergence here. But if we go up much more than that and we start to take out these divergences, it just doesn't make a case to short or to even stay short. At some point, you need to stop out. Somewhere in here, that somewhere is going to be relative to your price target. I gave you targets on the chart that I posted, and they're right here, 47.45, 46.50, 4,600. And then if we can take that out, and I'll let you know at the time. If we start reversing and get down there, again, I'll give you my thoughts at the time, but if we break that, that would open the door to this. And if that starts to happen, it's going to greatly increase the odds that we're going to go down to those longer term swing targets that I've been posting for weeks and even months now on the daily and weekly time frames. So first things first, by the time you watch this video, I'm going to get out to you as quick as possible. Ideally, the S&P 500 futures remain under 4,800, even if they punch back up below. And if they do happen to regain 4,800, at best, to keep the bearish, case well and alive for now, need to see a rejection off a back test of the wedge and to keep that divergence in place. Okay, not sure, but I'll cover this again. This was also in that in the comment section today. I set a break below this trend line right here. And you can see I also have a comparable horizontal support around 474.90-ish, which we're on right now, literally as I'm doing the video. And we're on that level. I've created that line back 2 days ago. Last time I was in front of my desk. And that's right here. So we're on it now. So this is a good example too, what I said short below 4,800 yes, but then looking at this, well, you got to take that out too. And you need to take it out on a 60-minute closing basis. It's a 60-minute chart. I think we will. There's sell signal 1. I'm going to pulse a break below the uptrend line. And let me tighten that up a little bit. There it is. Still comes in the same area here. There's a big divergence. And so, yeah, those are your targets right there. Near-term targets, 1, 2, 3. And when we get there, the way it works is you might say, okay, Randy, well, that's only a 5% drop. Well, you know what that's going to do here? It's going to bring us down here off that divergent high. It's going to firm that up. It's going to, on the weekly chart here, help to firm up this negative divergence. This is unconfirmed right now. We have huge divergence building on the S&P 500. It really comes back from this point all the way back here. That was DH1, divergent high 1. We had a big correction, one of the biggest in months. We gamed it. I'm on a week, and this is a weekly chart. That's the initial leg down in the bear market. We hit what I labeled long-term T1 way back when, initially back in early 2022, and we hit that. That's a major target. It's more significant than a near-term target. We bounced, and now my next stop should be long-term T2 and long-term T3, and quite possibly I added recently, a couple months ago, long-term T4. So that's my longer-term outlook there. And now what I was getting at, so a second ago, is, this is why I trade multiple time frames. And so, I've heard, and really leading up to New Year's, some of these, most analysts and technicians tend to be bullish all the time, but and quite a few, even those folks were calling for at least pullback. They acknowledge that, hey, we're ahead of ourselves. We at least need a correction. We're probably going to get one sooner than later, obviously, when you're going up as much as we were in the year end, and we got that. But their mindset is we'll get a little pullback. So where I'm going is, so let's just say I'm right. So they say, okay, well, we get that 5% pullback. But what that's going to do on the longer term charts is going to help roll the indicators over. In my book, again, this is just me. This is what I call potential negative divergence down here on the indicators. I'm going to expand it. And it's potential. You have right now lower highs in the PPO and RSI. But what I like to see to confirm it is the PPO, and here's the blue line's your PPO line, turn down and cross below that white line, the signal line, to effectively put in a lower peak. Because, as I often say, these are momentum indicators. And if you look very closely, what's the momentum right now in the weekly chart? It's upwards. The trajectory is upwards. The line hasn't even rolled over yet. So if and when it does and then crosses over, we will have confirmed negative divergence. That will be the first time since right here, yes, at the very highs, highlighted back then, reason we were short, and looking for, and I wasn't looking for, like the rest of the world, a correction. I was looking for a bear market, which happened because it was weekly divergence on the weekly chart, just like we had leading into COVID when we had a bear market. It was a fast one, 36% drop over a matter of 6 weeks, but it was still just that. So anywho, and that's where I'm going. So if that seemingly innocuous, 5% or so pullback on the 60-minute charts plays out to those near-term targets, again, that then can and almost certainly will have repercussions or implications on the longer-term, more significant charts. Okay, and I already covered QQQ for you. Yes, I did. That's it. So we hit, we hit that target. There's the reaction, just as drawn today. Sell signal 1, bounce back test. Took out 4748, hit 40583. We go up here, and the next stop should be down here if it plays out to plan. We'll see. Again, don't want to see it take out this high. If you do, you're going to run at and probably punch above that, put a marginal new high above that high. It'll still be a divergent high on a longer term time frame, but it's just shows a lot of resiliency in the market here. And and on that, I'm sorry, and then I'll get to the small caps here. Remember, what I said there too is one thing if you are shorting Apple. Oh, it looks like a perfect tag of that T1 right there. Look at that. That was from right here. We entered that one here. I said we could go down to here because that would match with my pullback, the downside for the target in the stock market, which was 1%. And we hit that to the button, rallied. So there's Apple, hit T1. And so where I don't want to see it for the short or bearish case is a move above that T2 zone. You have a downtrend line coming in and price resistance. So anything much above 192, in my opinion, will open the door for new highs in the Nasdaq 100, in the S&P 500. But now this makes me feel better that that's been hit. Sounds weird. Most of my price targets, unless the trade just never takes off at all, but usually the price targets are hit, at least my minimum targets. And that's why I have multiple targets. And so now it feels a little bit better for the bearish case that T1 has fully been hit almost to the button. What was the high today? 187.05 versus 187.17. We say these are the actual resistance levels. And you'll want to sell a hair below. And we're talking, 12 cents on 187 point security. I'll let you do the math on that, but that's measured in just a handful of basis points, not even percentage points. So let's go to, last but not least, let's not forget about IWM. All right. Remember back here, heading into the end of the year, I talked about this massive resistance level, 199. It's this big trading range we've been in for the past year in IWM. And you can see it, it's clear as a day. A blind man can see this in the charts. It's so obvious. And so it's just been, up, down, up, down, up, down, up, down. And I said, as we're coming up to here, how big 199 is a big resistance level. And I said with confidence, I had a high degree of certainty or confidence that any breakout above there would fail because it would be, I cited the reasons, showed you here every single instance. And when you were overbought, that was it. And then especially with divergence, you got a little divergence on that overbought reading. And then I said the overbought is not the sell signal. It's overbought followed by a bearish PPO crossover, which again at the time appeared imminent, high-level bearish PPO crossover. So there it is. So you can see the instances, and you can see also what happened in each of those instances. Let me do that for you. Let me circle that and show you. Okay, so the last time it happened at the top of this range was right here. And we fell down there. And then we had that one, we fell there. And we had this one, we fell down there. So I don't see why this would be anything less. As I often say, from my experience, one of the most bearish developments in the charts that I've ever witnessed, and I see time and time again, are false breakouts that fail. Just like, breakdowns to new lows or breakouts, false breakouts of the downside are very bullish. That's very bearish. The reasons in my head are several. Number one, it blows out the shorts. Shorts give up, because they're mechanical. They look and say, okay, 199, so my stop should be above there. So they get blown out, and they're the not only natural buyers. They help buoy a stock or market, when you have high short interest because they're buying all the dips. They're covering their short positions, booking profits. So when they're gone, it opens a door usually for a bigger drop. And it also sucks in a lot of new money, seeing the breakout. Bulls that see the breakout, that don't read the charts the way I do, say, that's a breakout to new multi-year highs. We just popped above the range we've been in for the last year, so that's bullish. Well, it was until it failed, and then when it failed. So my point is, again, if history repeats, doesn't always repeat, but it often rhymes, and this is only the beginning of a much bigger drop. Now, look, I just spent all that time talking about it. If we do this, here's the thing. Maybe they're just pulling back in and we're going to go up here. So at this point, that high shouldn't be violated. So, if you shorted it or you're short IWM, again, where your target is that's what really matters. But let's say you are targeting, let's say you shorted the breakout or even you waited till it fell back below 199. You're targeting the bottom of the range, 163. That's going to be an 18% drop. Well, on an 18% drop, you can give yourself a 9%, so it would be a 2-to-1, way up there. That's too high. You can give up here is about 4% stop loss, just above that recent high, and that's an excellent RR. So that's how you would swing or trend trade that. Now, if we get down to the bottom range, if this fails, I'm also going to add to this. That trading range is very long in the tooth. It's just like this one, but on steroids, right? Same thing here. Same thing here. You had a false breakout above the range, very well-defined range. And that one at the time was long in the tooth. And so we went down to the bottom. Yeah, the dip buyers, everybody saw that was the bottom of the range. They did buy the initial tag, but after that, that was it. Then we broke down, and I think the same thing would happen here. In other words, this thing is very long in the tooth. If we get down towards the bottom, I would give very good odds that we're not going to go back up and then break out here. I'd give very good odds that whether we get an initial reaction or not, we go on down through there. And again, first things first, we've got a way to go to get down there. And this could just be a, back test that's coming a little inside the range and we still go up there. But again, I gave you easy parameters, how to trade it. If you are, you're looking for, if you're of a similar mindset I am, in saying that, this is T4. I created that fourth target back on March 8th of 2020, early 2022. So way back here, I gave you 1, 2, 3, 4 targets, and I still maintain those targets. I have all along. So, I'm kind of in a different place than most people, and most people see a big bear market. I mean a new bull market. I just see a bear market that's playing out as I figured it would, a very slow roll. Certainly didn't anticipate this clean sideways trading range, but there you have it. And by the way, that's still the next target, but I may very well add additional targets to IWM if and when we start to approach T4 down there. So just to put it again and quantify it, if T4 is hit, my next trend target on the small caps, that's going to be a 29, almost 30% drop. And if we go below that, it's not only good price support, it's not an arbitrary level. I just picked, a number. No, I based on where, the scope of the pattern, based on my analysis, the size of the divergence, everything else in the chart. It was, strategically placed, but it also comes in, or should come in most likely, if we get there when I think we would, because remember, stocks tend to fall a lot faster than they rise. We'll probably get there later this year. And if so, it will come in with that long-term secular bull market uptrend line. If that's broken, then we're going quite a bit lower over time. All right, so in summary, IWM, that breakout has solidly failed now, and that is a sell signal unless undone, meaning we come back up here and pop that high. So that's it. In other words, trend swing trader, should already be short small caps, especially on the break of the, they also took out the trend line there, the uptrend line. And, again, if you're targeting that would be a, nice near-term swing target. Came a little bounce on or around there. May come in here. There's some support there. I already covered S&P and QQQ in detail. And I wanted to, before I wrap up, let me just do this real quick, because let's not forget about the big three. Somebody asked something today. It was in that comment section that I did for you on the homepage here today. That one with the new highs on the S&P that I was reading earlier. And then I went on to say, keep a close eye on Treasury yields in the euro and US dollar, in addition to the major indices. Yields continue to inch higher since bottoming in late December, and the 10-year is close to taking out its post-December highs in yields, that is. If and when that happens, the more yields climb, the stock market will start to take note. I'm also watching energy and crude and natural gas. Energy, meaning crude and natural gas, as well as other commodities that can help reignite inflation worries. So again, I started the video with crude. Crude pops that uptrend, that downtrend line I showed you, and starts to run from there. That's going to further add to worries, and I'm going to wrap the video up here, which is I cannot overemphasize the importance of this, in my opinion, and that is yields. We were long and strong treasuries off the lows, and then recently flipped to short. And this is the 10-year. Where the TLT is the 30-year. That's the one we use for. That's the official trade idea. But there's that bearish rising wedge in IEF. Remember, this is the bond price. IEF is the price of the 10-year. Holds 7 to 10-year bonds, not the yield. They work inverse. So this is when yields bottomed. This is that little giddy up stock market rally we've had right here. Right here, the market was rallying, but yields have been rising, meaning bond prices have been falling. And you can see here, we've been dancing on this level. So what I said in that post or in that comment section earlier today, here's the recent lows. This is where I think the stock market will begin or restart that hypersensitivity. Remember what I talked about a few months back? Market had written off bonds as interest rates as peaking on the previous cycle earlier last year. And I said, nope, we can go up here. And if we do, and we take out the highs, mark my words, the stock market will become hypersensitive to yields. And it did. And that's why we had that big correction earlier in the year. And that was when yields peaked. Then they started to abate. And I'm just going to end it here. First, so I think right there, we're not far from it. Now, you can pull the yields. That's TNX for the 10-year yield or TYX for the 30. But some of you might not have that on your charting platform. Everyone will have IEF. If you have a charting platform, it's going to give you quotes on ETFs. And so this is the 10-year. And so all you have to do is watch right here. There's your recent lows. If we pop below there, and I think we will, you can see there's my next stop, my next target. This is where the stock market's going to start to say, rut-row, what's going on here? This is, this is not good. We're seeing yields start to back up again. There's an uptrend line, which is a target as well. And I put pretty good odds at it being hit. TLT, same thing. Got coming up on a support zone. You've got a target zone down here. This, again, I can't promise you it's going to happen. I think it's going to happen. And if it does happen, I can all but promise you that the market will take note and start to react negatively to that. And if that does happen, in other words, bonds prices continue lower as yields continue higher, and we see energy, especially crude, more so than natural gas. Crude's a big one that moves the needle. We continue to see crude start to rally. And again, look at everything else. Look at grains and industrial metals and everything else, and they rally too. Then that will put added pressure on the stock market, because that will start to you'll start to hear whispers again about the reflation trade and inflation coming back. And again, it's incremental. It's not like if we break the recent when the 30-year just broke, it's just punched out to new highs. New lows in prices, which means new highs. I'm talking since this peak here. And like I said, watch the 10-year. The market puts a lot of emphasis on the 10-year. So I was saying, if that happens, we start, yields continue to tick higher. It's incremental, and it should, almost logarithmic, if you will. The drop here. If bonds continue to drop like this because yields are going up, you're going to see increasing pressure on the stock market. Doesn't that mean the market's going to crater if we go drop below this peak low right here in IEF? But you get down here. The more you get down there, the more you will hear the narrative I'm telling you you're going to hear, and that is, something's going on. And I'll end it with this. This is what I wanted to say. I've been doing this for longer than I care to remember. Professionally, going back into the early 90s, mid to early 90s, working as a financial advisor, stockbroker, business grad, dealing in the financial markets my whole life. And I can say, and I'm struggling to try to think back, but I can't recall many other times in history where I've seen such a one-sided sentiment among all market participants regarding yields, bond yields. Stock market, you still have folks that, yeah, I know the majority are calling for, big, nice gains, positive gains, bull market in 2024. And I know I'm in the minority and have been there calling for not only something, something a lot different, not just negative returns, but a big drop. But where I'm seeing is just about everybody. I find anybody. I'd struggle to find anybody that thinks bond yields can go down substantially. I think the consensus is yields have peaked, and we will not see that, and we're going to see yields fall substantially through 2024. And even though I've shared my longer term outlook, I think we probably will. However, if we don't, here's what I'm trying to say. The market, the house can't let, the house always has to win. And if everybody's betting against the house, it's the stock market, or in this case, the bond market. And if everybody's positioned the same way, that usually doesn't end well. So all I'm trying to say is be open to the possibilities and get out of Dodge as far as the stock market goes if yields start to surprise everybody because everybody's positioned one way and thinking they're going to go one way. This is the 10-year yield. There's a peak right there. There's a channel we broke out of recently. And so again, I don't think it's not an all or none thing. It's a breakout here. But if we start to go up here and we get anywhere near those previous highs, and God forbid we punch above that high, wow, you won't want to be in stocks if that happens. We get up there, and I can see there's a possibility. There's a long-term trend line I have in TNX, the 10-year yield. And maybe we go up to back test that. And one of the problems from a fundamental, forget about the psychological aspect of it. That's huge, by the way. Don't dismiss it. Just put that aside for 1 second. We've heard, and again, the narrative is everybody has been on the tune that rates have peaked and they're only going lower. And we know statistically there is a massive amount of debt coming due in the financial markets, and both consumer and business debt that will be rolling over in 2024 and 2025. And so the narrative driving the gains for 2023 have been that it's okay because rates have peaked, and by the time that debt rolls, we're going to be back down here. Rates are going to be a lot lower because the Fed's going to start a rate cutting cycle. And okay, maybe so. And if so, hey, that is a fundamental headwind for the market. There are other things that can affect the stock market, but that is a net plus, right? But God forbid that happens. And it is one of scenarios, believe me, that I'm factoring in. And I think it has a decent chance. I'm not going to put odds on it, but I'm very much open to it. And it would help mesh with how are we going to get to where I think we're going to get on my equity market targets. How is the S&P and the Nasdaq going to drop 40% or more over the next year or two? And that is one thing that could do it right there. So I just wanted to point that out. And again, the takeaway is you don't have to agree with me. Believe me, just watch yields. And just know that incrementally from this point over the recent high, there's a spike from last week. This is the 10-year. This is where I think the market will start to wake up and say, hey, something's going on here. This isn't just another one of these counter trend blips. We're supposed to do this, but if we start doing this and there's another major reaction high right there, that's where the market will start freaking out. That's where you want to own VIX and be short stocks if you're not already, when we start taking out if and when we start taking out those previous highs in the yield. Okay, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart.